Do you know which investments have produced the highest average annual return over the past 30 years? Stocks, believe it or not. And yet, almost 40% of Americans don't own them. That is a crazy stat to me as a financial advisor. Today, we're gonna talk about how the stock market works, what a stock is, how you make money in the stock market, and plenty more. Today on Mindset with Brad Barrett. Let's go. Hey everybody, welcome in. I am Brad Barrett. This is producer Jared. And as always, the lovely Kira. You have joined us here on Mindset, and we're gonna be talking to you today about what the stock market is. Before you click away for a second, just think, oh, this is like some very elementary show about what the stock market is. Likely you have an idea about it, but we're gonna talk about what it is, what a stock is, how you make money. We're even gonna touch on some things of risk and reward. So I'm excited about this one because this is like right in my bailiwick, a word I know you love.
Yeah, it seems very simple, but to be honest, I mean, I've talked to a lot of my friends. It's like, oh yeah, stocks, buy stocks.
Yeah.
But the really nuances of how this works, most people could not tell you about.
No, we're gonna, and so I want to start it this way, and I'm gonna give you a chance, but I want to start with you.
Oh.
If I were to ask you right now, what is the stock market? How would you describe it in 30 seconds?
The whole market?
I'm giving you a chance. I'm gonna come to you next.
No, I know. I'm getting things to think.
Wait, the market or like what a stock is?
Just the stock market. If I were to say, hey, what's the stock? If I were your kid and I was coming to you and say, hey, what's the stock market, Dad?
I would say a stock market is a
Tricky,
a
right?
store where you buy shares of companies. An online store.
You watched my short the other day.
I didn't. Is that what you said?
Yeah, we did one. Same question to you.
Well, I watched your short, so.
Yeah, it's an unfair question.
Yeah, you filmed the shorts.
By the way, go and take a look. I did a little video on this kind of stuff to kind of give you the basic level. But I think I want to talk about this because generally speaking, this is a topic that most people have familiarity with, but not an in-depth knowledge of. And we're going to try to do our best in a pretty short time period to walk you through, something that's been around for over 100 years, something that's by and large a very well-known wealth generator, which is ultimately, I think, something that everyone should have. Not maybe in its entirety, you should be diversified, but it's a huge tool to be used for your wealth generation process. Not just for you, but for your next generations. All right, let's talk about the stock market.
Stocks. Markets.
Stocks. Markets.
Bears. Bulls.
Bears. Bulls.
What bears best?
Buy. Sell.
Wait, did you say Bears beats Battle?
Yeah.
Bears beats Battlestar. Oh, an Office reference. Oh, you're an Office fan. That's right.
Oh,
Okay.
yeah, okay.
We're still
Black Bears
testing
best.
Kira on what do we call it? Like must-see TV knowledge.
It's usually movies.
Excuse me.
I feel like
80s and
TV
90s babies like Jared and I, we're always in the next like, have you seen this movie? And I think every other day, we're finding that's like, no, I haven't seen it. I'm like, what?
Yeah.
I don't have a lot of free time, but.
Well, I got to give you some more free time because I feel like I'm going to give you a day off. And like your entire list for that day is you and Dylan just watching these videos.
Just gonna rot all day long.
Probably.
And get cultured.
Hey, have a cheat day and just enjoy it.
Right.
Some of them are pretty good. We're always curious what holds up.
Right.
Yeah.
You ever thought that, like what the movies you're used to, the nostalgia, like what actually still holds up today?
Let us know what you think.
Yeah. All right. So we were doing some research on this, and I want to start with this because I think this will be fascinating to you guys. So according to a study by the American College of Financial Services, only 28% of U.S. adults passed a basic investing literacy quiz.
Those are failing marks. It's not a lot.
Not a lot. Now, on that same study, over 70% showed limited or poor understanding of basic stock market concepts, which is why we're talking about it today. Now, last stat for you. There's a Gallup poll this year, 2025, revealed that about 40%, this one got me, 40% of Americans don't own stock.
Same.
So you're in that camp. Are you in that camp?
I don't know how to answer that.
Do you own an ETF, a mutual fund, or an individual stock?
I have an
in the stock
IRA.
market? So an IRA is an account, and inside that account, what do you own a stock or?
Yes.
Okay, so you wouldn't be in that category.
Okay.
Okay.
'Cause I don't own like a Robinhood. Like I've bought Apple stock and I did that.
See, there's a lot of connotations going on out there. We're gonna get some education today.
This is what I'm talking about.
Yeah,
like
I
when you
agree.
say stock, I'm like, I don't know how to answer that.
We're gonna talk about
I
it.
think I do.
Well, and like the IRA holding, like anything other than just like cash is kind of an interesting concept.
Lately, we've been talking about that with some of our shorts we've been doing. So let's just talk about it a second. People say, I've heard this concept before, and they'll ask it this way. What does an IRA earn? If you would that, I get that question a lot.
Money?
Well, here's the thing. An IRA, it's like asking what a checking, an IRA, it's a banking term because when you talk about checking or savings, they typically have a stated like rate like in a checking account, super low, but it's there because the bank's just offering it through their accounts.
Like a set.
Yeah.
Earning
An
percentage.
IRA, a Roth IRA, a 401k, a 403b, 457, retirement plans, they don't necessarily earn anything. They're an account. What you put in it is what has the returns to it. So that's just a really simple, high-level version of this for a second, okay?
Yeah.
So what is the stock market? We did a short on this the other day, but think of the stock market like a grocery store. And in that grocery store is all the companies that are public. Now, I think it's important to note that the public market is a company that's grown to say, hey, we want to raise capital to grow our service or our good, right? Whether in your goods and services business, right? So you go public, and by going public, you're raising capital. When you raise capital, like if XYZ company wanted to go public and the three of us were the entire investing world, right? And we invested in that company, we're giving them $1 each, $3 that they didn't have. And we're in the onus that that company is going to use that $3 to go and expand and grow their company, okay? Now you get into the whole idea of growth stocks versus value stocks. That's a different conversation, but we're growing a company and we get paid back on that, right? Through either dividends or appreciation in the stock.
What's a dividend?
A dividend is essentially a payment back from a company that you would own. They're basically saying of their profits, they're going to give back a percentage of that to stockholders as income. So they're rewarding you for staying a stockholder, an owner of the company.
So how is that different than like the share going up and then you having?
You get both.
Okay.
It's so you get so think of it. The best way to describe this for people who really have no background in this is think of real estate. Right? A lot of people the social media world just loves to talk about passive income in real estate, right?
Yeah. I want some passive income. Please.
Let me be very
Own an Airbnb.
Hold up, back up, everybody. This is going to sound a little on the nose. The original passive income was dividends. You're literally doing nothing and you're receiving money. I should be clear. I love real estate. I'm not an advisor that's like all equity guy. I love real estate. But when they come at me like, oh, I want passive income. Dividends are passive income. Walk me through how it's not passive income. I would argue even more so, this is going to get, people are going to hate me for this one, but like it's more passive than real estate. You as a landlord have to do stuff.
Sure.
You have to go fix stuff. Yeah, you might have a property manager, but you still got to manage them. You have to do stuff. If you own XYZ company or whatever company they're paying you a dividend, you literally have to do jack nothing, right?
So
that's passive income.
Yeah.
Dividends are guaranteed. Like they're like, here's this
whoa,
percent.
Whoa, Kira, the G word.
I'm sorry, that's like forbidden here.
That's like a forbidden word in my world.
Right.
Only thing
okay.
guaranteed is death.
The only guaranteed thing in life is death. There is nothing guaranteed ever, and it's a fluctuation, right? And there's a whole bunch of things that stocks and companies can manipulate on. They can do buybacks. I'm not going to get into all that today, but there's a lot of corporate financial structures they can use. It's all above board. It's all Sarbanes-Oxley, which is the rule out there for public companies and the accounting rules, the GAAP rules, all these things to make sure that the SEC is keeping public companies accountable.
But I'll say this the way I understand this, and correct me if I'm
Sure.
wrong. So if I own a stock, a dividend is something like they get profits on that they share to all their owners. So you
Correct.
get like a
Right.
check
Yeah.
or whatever it is, you get money, but you still own that stock.
Yep.
Right.
Like making money on a profit, if you have to sell that stock.
Yeah.
Right.
So
right.
if that goes up, you have to sell that to get that money, but dividends, you get to keep it.
So they basically give you a check.
Yeah.
But how do I know if I'm out there choosing a stock,
Mm-hmm.
how do I know if they're a growth or they pay out dividends? Is there
Oh,
somewhere
you look
like
it up.
they
The ticker
post-
symbol will say it right there on the profile page. Look up Coca-Cola. I think that's a good one. Ticker symbol's KO. Everyone can probably relate to that. Everyone knows what Coca-Cola is, right? Type it in there. Probably right there on the top page in the middle, talk about key statistics or like things like that. It'll say dividend yield. Does it say that there?
Forward dividend?
Yep. 2.91%.
Boom, look at that. Let's use a round number of $100. If the stock that you own is worth $100 and your dividend yield for that company is 3%, you get $3 of dividend of that check you're talking about back per share you own. Make sense?
Right.
So if you own 100 shares, you're gonna get $300. And they pay it at different times depending on the company and stuff like that, but that's how a dividend would work. And you're also investing in the company. So Coca-Cola is a good example. Like they're gonna grow. Like I'm sure, people might have bought in that company when they were $20 a share, right? So you're still gonna get appreciation on it as well. So it just shows the difference between value and growth and how dividends work. And interesting enough, that's one company. And as of mid-2025, just so you guys know, of all the public companies that are out there, there's between 50 and 60,000 publicly traded companies out there.
It's a lot of companies.
A lot of companies.
And it's a lot of companies to research if you're trying to find, So ways to make money. I mean, how do you weed through 50,000 or 60,000?
It is, and this is where a lot of people might be watching this, are day traders and DIYers and do-it-yourselves. And look, I mean, like for example, when we talk about the stock market, we just mentioned what it is, kind of like a grocery store. You go and buy little tiny ownership in companies. Okay, there's also different indexes. You have the S&P 500, you have the Dow Jones Industrial, you have the Russell 2000, you have the NASDAQ. They serve different purposes. That's for a different show. But typically the Dow Jones Industrial is the 30 largest companies. Doesn't have to be domestic. They're just the largest companies that are public, right? S&P 500 is the largest 500 companies. So it's a little bit different. There's a whole reason to that. The DGIA was an industrial, index 100 years ago in the turn of the turn of the century kind of stuff. That has since changed. There's different ways to manage those indexes, but there's also, when you go to the stock market and you talk about the, where it's on, those are some good indexes to use to find some of the companies that are being tracked the most. So when you say this world of 50 to 60,000, go look at some of the indexes and you'll find some of the larger companies, the S&P 500 and the Dow Jones Industrial Average. Some of the smaller middle companies are more in the Russell 2000. NASDAQ has a lot of technology companies. So there's just different places to find things.
So and then those are the exchanges that they're on.
Yep, those are the exchanges.
Which I read, and that there's 60 to 80 major stock exchanges.
I mean, there are a lot of them. There's really only a handful that are, I would say, in everyday use.
Gotcha. Okay.
I mentioned them: the Dow, the S&P, the NASDAQ.
Now, are those different than, like, is the New York Stock Exchange different than the London?
Yes.
Tokyo?
Yes.
And those are different than NASDAQ?
Yes.
And S&P?
Yes. Again, a different show. That's a whole host of conversation there. So, thoughts on that?
Do you have clients that are like, I'm just not going to participate in the stock market?
Yes.
Okay.
There's plenty of people that come in that I talk to that I'm really fortunate and blessed to talk with them, that are like, hey, look, heard about you. I'm kind of reluctant to come in. Took me a while to call you. Just so you know, this other week I had this. Just so you know, I hate the stock market. Like, as a financial advisor, like, I was being cool with them, but I'm like, God, that's every financial advisor's greatest words, right? But it gives me the opportunity to talk, when I'm talking to you guys about this video, to talk to them about it. I said, well, my first question is, where I'm gonna go with this, is why?
Right.
Understanding the back, and there is always a story to someone saying that. So the 40% of people who don't own stocks, there's always a story. And my experience has been as to why. The main ones are, I was in it, got burned. I was raised in an environment where the stock market I was always told it was, don't invest in it, or it's just a gambling casino. Like, or the other one that I always say is, if they're honest with themselves, like, well, to be candid with you, I just don't understand it. But since we've touched on those subject matters, it's worth discussing risk reward. So risk reward, life is risk. I think people, when someone talks about, oh, it's risky, my economics brain kicks in, and I got to say this. We study risk in different ways than I think the average person would study it. Now, did you guys know there's like 50 different types of risks out there? Like, when you say risk, when you talk about the stock market, you're thinking of loss.
Right.
Sure.
Right? Capital loss, market loss. You bought something for $10, it's now worth $8. That's what you're thinking, right? There is, just to name a few, there's inflation risk, business cycle risk, economic risk, political risk, geopolitical risk, opportunity risk. There's a whole host, credit risk, interest rate risk. You name it. All those things have their own topics within themselves. So when I talk about risk, I like to educate, saying, when you're really asking about risk, you're asking actually more about losses and your fear of losing. And there's strategies to employ this over the long haul. I've said this before, I will always say this. Time is your number one investment. Time is the number one commodity here. The sooner you start your investing life, the sooner you can start seeing your averages work for you. Those numbers we mentioned, it's hypotheticals that are real stats. You can look them up yourself. The stock market is averaged between 7 to 10% per year for the last long while. That doesn't mean you're making 7 to 10 every year.
Right.
Okay. People need to really understand that. So you got to ask yourself, can you weather a storm when the market's off 20% in a year, like negative? It's not a good feeling. I've been there, right? But you look at the longevity of everything, it's just shown itself to be a wealth generation. So the stock market is a huge place to educate yourself on. Hopefully today's video kind of touched on that. The stock market is the grocery store to which houses the stocks, and in the stock world is how you start making some money. But I wrote down a few that I think are important in terms of risk of investing for the stock market in particular. The first one that comes up, which I think bugs everybody out, is volatility.
These are the risks.
These are the risks. These are the risks of the stock market if you want to calculate it, okay? Risk of the stock market, the first one comes up is volatility. It's going to move.
Yeah.
It's going to move up and down. You got to be able to control it. Okay? Prices, this is the 3-month thing we did in high school, the supply and demand. Think about it. If a stock is in demand, people are buying that stock because it's, for whatever reason, I'm not going to go into details on that, right? It will likely be growing because there's more demand for it. When it goes out of demand and there's bad press, bad news, it's not getting their earnings, right? You're going to see a reduction. People might be selling it or moving off to another stock or things like that, right? It's going to be volatile. The stock market has proven to be volatile, but over time, volatility smooths out.
And I think for me, the part of this thing that scares a lot of people is the reasons it's volatile. And
those are some of the reasons I mentioned.
Well,
political, geopolitical,
exactly, but
pandemics.
Look at GameStop.
Yeah.
You have these things that are, a bad press release, something comes out. It comes out of nowhere. You have people manipulating it, whether for good or bad, which happens all the time by banks, by corporations. Like this is a game they're playing. And if you're not in the game and in the know, you can get burnt really bad.
You can. I understand the theory of game, and I've always not the GameStop, but the way of describing the market as a game. If I'm being candid with you, I always kind of struggle with that term because it's not, but it also is, because games, when we relate to sports, have strategy.
Yeah.
So it is. There's a strategy to it. But if you go into it not having a strategy, like any game you've ever played, board game, sport game, doesn't matter, it's probably not the best approach, right? Because you could get burned.
Sure, but there's two different games being played. There's games by corporate execs, major banks, hedge funds. They're playing their game, and then we're playing our game as the investors, and we're trying to match what they're doing with the. You know what I'm saying?
I do.
From a layman, that's kind of how I see that.
I know, and here's the thing, and sounds a little conspiracy.
I love it. Bring it.
I know you do. So I'm gonna push back a little bit and just say, yes, there are legal things that they do. They may do dividend buybacks or stock buybacks and repurchases and splits and things like that. All these things, and that might seem manipulative, and to an extent, I can see a case where it is, but it's also corporate structuring, all legal. Okay, so there's ways to look at that, but end of the day, the game that's being played, you still, I think, should be a part of it. So volatility is a big one. Market crashes always scare people. That's a huge risk in the stock market.
Scared to death.
Always.
Yeah.
That's what, by the way, this is, forgive me for saying this, it's an old term, but this is what separates the men from the boys, is market crashes when it comes to investors. It's what you do. To me, the successful investing that I've seen in 2 decades, it's what you do when markets are going down that matters more than what you do when markets are going up. And a lot of what you should be looking at is what you're not doing. And if you're not selling, particularly panic, fear selling, that's usually the right strategy. Again, that's a contextual thing based on your age, time horizon, a bunch of stuff. But you see what I'm saying?
Yeah.
Separates the men from the boys. Another one is emotional. We talked about this a lot before.
I had a couple shows on emotional investing.
Huge behavioral thing, because I call it the pocket investment. People fall in love with something. Like, for example, your friend, they probably fell in love with the idea. I loved that whole thing in a weird way, personally. Not from a market guy or.
Did you buy any?
No.
GameStop?
But I loved the idea. No, I loved the idea of what, I just think it's cool what people can do when they work together. That's kind of what it said. That's what, I mean, I'm a team sport guy.
100%.
I grew up with a team. Like, I love the notion. I've always believed in it. That's what I employ with our employees here. We have over 90 employees spread across 9 or 10 different offices. Like, we are huge team players. I come from a team sport guy, playing hockey my whole life. And I'm like, we are only as good, you've heard this term before, as your weakest link. Right? So it's really important. I thought the cool part about all that was what it showed we can do if we really put our heads together, right?
Yes, we can manipulate the market.
Well,
moral of the story.
Well, outside of the manipulation part of it, you always go there. Outside of the manipulation part of it, I just think it was cool. But emotionally driven, most of the people I would say, I would argue that they were kind of like, oh, this is kind of cool. And I'm into it emotionally, not fundamentally.
And that got very emotional, I will say.
Big time. Big time.
Yeah.
So that's why I think we tend to buy things, or the pocket investment is just as good, right? Oh, I got an Apple phone, so I think, oh, I gotta have Apple because everyone got it, right? Yeah, that's fine, but like, are you looking at why you're investing in it? Remember a couple weeks ago we talked about the why we're investing in and why we're doing what we're doing with our money. You know what I mean? Yeah. So emotional investing is another big risk. Company-specific risk, I think, is always important. I've shared my story before, but you're looking at an advisor who's been doing this for 22 years because my dad worked for a very large Fortune 500 company and they went bankrupt from greed, absolute corruption. But to hone in on one company out of potentially 60,000.
Well, that's the point. You don't put all your eggs. So if one does go down,
correct,
you're not. But it's cool to see hear a story like that, because I think that's another fear is once you go, once you roll craps, you're out of the game forever and your life is destroyed. But you can, depending on time, you can rebuild and get back up.
You can. And I think the important part, and I share the story, my dad and I talk about it a lot, and he goes, at the time, a lot of his stuff was invested in that company, and it probably shouldn't have been. You probably should have been diversifying. I think anyone would say that in that camp, right? That's why what I'm saying to you is there's diversification versus concentration, okay? That's how you avoid some of these risks, by the way. And the last one I put on there is there's no guarantee. The G word.
No guarantee.
There just
No
isn't.
guarantee.
If you're walking into this thinking, oh, this guy randomly said I'm going to get 10% per year, then you heard me wrong. I've said it multiple times. This is an average, and it's not that it's every year. You have to be willing to understand the risk versus the reward. There's no guarantees in life or in the stock market. So you have to understand these risks relative to specifically the stock market, outside of just the economic risks that are out there. Those are the kind of the macro risks that sit up top, and then you kind of get granular and down deep. And these are some of the risks that happen that I think we all fear when it comes to the stock market once we get to know it.
For sure.
Anyways, I hope you guys enjoyed that today. We did. We talked about kind of what a stock market is, what a stock is. You can do your own research on some of this as well. We want to thank all of you who are our subscribers every week and commenting.
Thank you.
We love you all. We're growing and we're just very, very, very fortunate and blessed. So thank you all. We're almost at 10,000 subscribers.
We're growing quick.
We're growing quick, which is really cool.
Tell your friends.
We're just doing this and trying to write stuff as we see them.
Having fun, teaching.
Having fun, trying to teach and doing our stuff. So
Learning.
yeah, if you're not you're learning. If you're not subscribed, please do so. We come out with weekly content every week. And as always, if you lead with love, everything's gonna be all right. See you guys.